Welcome back to the channel, guys. Keith at Crypto Bullseye. So this one's going to be a deal breaker. Lots of people in the Discord group have been asking me questions as to how they can protect themselves, how they can preserve their capital, and how they can ensure that they've got a good chance of success within the crypto bull run. Guys, I'm not a financial advisor. I'm not going to tell you anything, but one thing that I will do is educate you so far as risk management is concerned. There's lots of things that you can do to take emotions out of trading. Why do you think computers, why do you think trading bots do so well? It's because they've got no emotions, guys. And that's how you need to think. You need to have if then rules built into your trading. And that's what we're going to be talking about today. By the end of this video, you're going to understand an if then syntax rule with a trading strategy that you can apply to your own charts to ensure that if something happens, then the next thing needs to occur. If the next thing occurs, then the next thing needs to occur. And at any point, if one of those metrics don't happen, then you don't take the trade. And that's how you take your emotions out of trading. So the metrics we're going to be using today is going to be the simple 200 daily moving average. That's going to identify whether we're bullish or whether we're bearish. The Fibonacci retracement, and I'm going to simplify that even more by tailoring it. The stochastic RSI, which is going to tell us if the market's overbought or oversold, and a simple trend line. The trend's our friend till the bend at the end. So stay tuned right to the end. Let me know in the comments what you think of this video and whether you want more videos like this, and share it with any of your friends that you think might find it useful. Okay, and I'm really going to slow things down in this video, guys. Get on TradingView and follow this step by step and just help yourself understand what's fair value on a price chart, how you can understand how price moves on a price chart, how you can protect yourself on a price chart, and building these rules or building your own rules to help you ensure that you understand when you're wrong, you've got protections in place, you can preserve your capital, and you can live to fight another day. So the first thing that we're going to do is we're going to simplify this. We're going to add our indicators on there. Our indicators are going to be the tools to allow us to know whether we can move on to the next step. And the first one that we're going to do is the 200 daily moving average. Why is that important? I'll add the indicator on first, but the 200 daily moving average is our metric to identify whether we're bullish or whether we're bearish. If price is trading above the 200, we're bullish. If price is trading below the 200, we're bearish. As simple as that. So we're going to click indicators, and then we're going to click MA. I'm going to go down. I'm going to go down, and we're going to click the moving average down here, simple moving average. So we're going to click that, and then you'll see this on the left-hand side here. What we can do is amend the settings on there. So we're going to click the settings, and we're going to go inputs, length. That's 9 days at the moment. We're going to change that to 200 days, and then we're going to make it thick like that, and we'll turn it green so it's more visible. So let's check that now. Got your 200 daily moving average. You can see one thing here. When price is below, it's going down. When price is above, it's going up. So that's going to be our metric to tell whether we're bullish or whether we're bearish at any key point. The next thing that we're going to do is the Fibonacci retracement. This is what people keep asking me time and time again. So I'm going to simplify this. Back to your indicators. Sorry, not your indicators. On the left-hand side, you've got your Fibonacci retracement tool here. So pick your Fibonacci retracement tool, click the star, it'll be added to your favorites down here. What we're going to do is I'm going to amend this in real time. So what we're looking for is we're putting in higher highs and we're putting in higher lows. When we're putting in higher lows, we're looking for a 618 retracement. And how do you know whether it's a 618 retracement? You're going from the swing low to the previous swing high, and you're waiting for price to pull back to the 618. So that's what we're looking for, and we're interested in the 618 area, but I'm not going to talk too much about that now. I'm going to move on. So what we're going to do next is double click your Fibonacci, and we're going to simplify this as much as possible. So I want you to get rid of everything apart from the 0.618. Get rid of everything. Keep the 618. Get rid of everything else. Nothing else on there now. So we've just got the 618. Make it whatever color you want. Okay, does that look easier now? So this is the aim in the game, guys. We're waiting for price to push up, pull back down, touch the 618, and then we need something else to happen. The next thing that we need to happen. So stochastic RSI is the next thing. You're going back up to your indicators, and you're going to click stochastic RSI. So this one here, I've already got this one. So you click stochastic RSI, and it looks like this. Now, anyone that watches my channel probably understand this is one of the easiest indicators that you can use. And if I just pull it up, you can see when the RSI is above 70, it's overbought. When the RSI is below 30, it's oversold. Now, I want you to see how that coincides with price action. Overbought, overbought, overbought. See, as we pull back, price pulls back. As we pull back, price pulls back. So that's going to be our additional metric. Are we overbought? Are we oversold? Are we at support? Are we at resistance? All paints a picture. So we've got our stochastic built in now. The last thing is going to be the trend line. So the trend line is going to be important from two fronts, and we're going to be using diagonal trends. I'm not going to be talking too much about horizontal in this because it'll just overcomplicate things. So we've got a diagonal trend line. We're putting in higher highs and higher lows. We know that because we're above the 200 daily moving average. So whilst we're in a trend, trend's our friend till the bend at the end. You're going up, you're pulling back to the 618. Once you're at the 618, then you need something else to happen. What you need to happen is you need the stochastic to be oversold, and then you can wait for a break. Once you've got a break, you can wait for the close. Once you've got a close, you can protect yourself below the lows. You can shoot for the previous swing high, subject to a minimum of 2-to-1 risk to reward. Now that sounds complicated. Let me just simplify things. So let's pretend we've got a trade. So we've got our 200 moving average. Got our 200 moving average. Price is trading above the 200 moving average to tell us that we're bullish. So what we're looking for now, guys, is a pullback and a break. And we need to ensure that as we're pulling back to the 618, the stochastic's oversold. Doesn't matter if it goes a little bit into the over 30 mark as we're breaking. That's typical. That'll tend to happen. Stochastic's a lagging indicator. That's fine. But ultimately, the stochastic's there for a first glance to say, are we overbought when we're at the 618 or are we oversold? So price pushes up, comes back down, hits the 618. We're interested. And as it pulls back here, price will do something like this. So we can monitor that and we can wait for the break when we get to the 618 to indicate that we've got a continuation of trend to the upside. Then you can pull back 618 at trend and continue. Trend your friend to the bend at the end. But what this helps do is helps you ensure that you can protect yourself below the low, and it brings in rules to ensure that you have to have a minimum risk to reward before you can take anything. So let's have a look at the rules now. Remember, guys, we're a computer. We're trading like a computer. We've got no emotions because we've got rules built in. Let's have a look at these rules quickly. Right, okay, so if above the 200 moving average, we're bullish, we're putting in higher highs, and we're putting in higher lows. Then we add a Fibonacci retracement from the previous swing low, remember from the previous swing low to the swing high, and then we're waiting for a pullback retracement to the 618. So if the price hits the 618, then we add our diagonal trend line. So we've got the diagonal trend line putting in higher highs and higher lows. But as we're pulling back to the 618, we put in our trend line, and that's where we're looking for a break. So we're putting in the second diagonal and waiting for the pullback and waiting for the break. So if the stochastics RSI is oversold at that point, so as we're pulling back, we're hitting the 618, the RSI needs to be oversold. Then that's going to be a tick, and it's going to allow us to move on to the next thing, which is going to be the break of trend. So if we get a break of trend, then we wait for the candle close. This is important. Why do we wait for the candle close? Simple, guys, because of the fake out. So you often get wicks that push out and then push back in. If you went out on the break on a daily candle and the candle pulled back into trend, then your position's not as strong. You haven't got as much conviction. But so you need to wait for the break, and then wait for the candle close. Sorry. The candle closes, then stops below swing low and targets a previous swing high. Let me show you what I mean by that. Because this is the important thing, guys. This is take profits and this is stop losses. So let's stick it back on there. We'll stick the trend line back on there. Got the trend line. You've got your 618 retracement. You've got your 618 retracement, and we're waiting for price to do this. It's come in, pull back. And as it's doing this, we want our stochastic to be from overbought, pulling back into oversold, resetting the indicator. Then we would be adding our trend line here. And then you'd be waiting for the break. So the stochastic's got to be oversold at this point. You're waiting for the break. Got the break. You've got the close. And then you're getting your protections. There's your close. Below the swing low, shooting for the swing high, subject to a minimum of 2 to 1 risk to reward. So that's just about a 2 to 1 risk to reward. So that's what's telling you that that's your capital. That's the upside risk. That's the downside risk. If you want it to be even more conservative and build another rule in, just trying to simplify this, guys, build another rule in, this needs to pull back and test support. If that pulled back and tested support, then you got another move to the upside. It's bringing your risk to reward a lot further down. So you can get the retest. It brings the risk to reward a lot further down. If you got the retest, it'd be down here. Be down here, bringing it to a 4.39 risk to reward. So that's the method in the madness, guys, just by having those simple rules. So just to clarify, putting in a higher high, we're above the 200 moving average. We're pulling back to the 618. As we're pulling back to the 618, the stochastic needs to be oversold. If the stochastic's oversold, then we're waiting for a break. Once we've got a break and a close, we're putting our stops below the previous low. We're putting our targets at the previous high, subject to a minimum of 2 to 1 risk to reward. Right, let's dive into the charts and put this in action. Okay, guys, if I was going a bit too fast or I wasn't explaining things, I do apologize, but we're going to go through price action now, and I'll show you step by step how you need one rule to happen before it moves on to the next step, and see if this paints a clearer picture for you. So first thing that we've got is we're identifying that we're bullish here. We've got our trend, we've got our first trend built in. So that's a tick. The next thing is the 200 daily moving average. That's obviously identifying that we're putting in higher highs and higher lows. So price is above the 200. If price was below the 200, we wouldn't be able to take it, and then we'd have to move on, find something else. So you're putting in higher highs, we're putting in higher lows, and then we're waiting for a pullback. What we're waiting for? Pullback to 618. So we're going from the swing low to the swing high, and we're not interested until price reacts at the 618. Price reacts quite a lot at the 618, guys. You'll find that time and time again when you're looking at charts. As you're pulling back here, 618, you've got a bounce, you've come back down, just come below the 618, and then it come back with a big buy up candle. And so we're waiting for a pullback now. Hit the 618, we're waiting for a pullback. We can add our trend line in there, and we're waiting for the break. But before we have the break, something needs to happen. The stochastic RSI needs to be oversold at this point here. While we're at the 618, oversold or pulling from oversold. So that's a tick. Then what we would have done is we'd have got the break here, candle one. There's the close. Protect yourself below the low. We've also got the 200 daily moving average as protection. Shooting for the highs. 2.11 risk to reward. If you were shooting for the high close here, 0.97, what would that tell you? That'd tell you you're not allowed to take it. If you were shooting for the extreme high, that would tell you you are allowed to take it, 2.07. So it needs to be a 2 to 1 minimum risk to reward. If it's a 1 to 1 risk to reward, that means that you need to win more than 50% of your trades. Doesn't give you as much of an edge. If you have a 2 to 1 risk to reward, you need to win 1 of every 3 trades, guys, to break even. So ensure that you've got good risk to reward there. That's why that's being built in as a rule. So let's go through and do this again. So if then, see if we can find any more. What about this one here? So we can go from this swing. Let's see if it happened here. From this swing to the swing high, we're looking for reaction at the 618. So you've got a pullback. We've got a reaction at the 618. We're above the 200 daily moving average. Sticking a trend line, waiting for the break. Just zoom in on this. You're waiting for the break. You've got the first candle close up here. Problem is, can't take this, guys. So this would have worked and this would have been perfect. However, this is a way that rules tell you that you can't actually take every trade. This is how you bring emotions out of it. This would have worked as a setup. However, at this green candle here, it's below the 200 daily moving average. We couldn't take it. So that one is validated. Even though it would have been a winner, it was invalidated. So these rules are there for a reason, guys. So that's how you can just build in simple rules. Try to make it as simple as possible. And sometimes I do talk too quick. Sometimes I do overcomplicate things. Sometimes I bloody confuse myself, guys. So let me know in the comments what you didn't understand, if you did understand it, if you found it useful, and let me know what you want me to cover next.